personal fan of Jess's, so I'm really looking forward to her speak on the topic of gold and why this time it's different. Welcome, Jess.
Hello everyone. I'm the height of a gold nugget, a very big one, so I'll bring this down so it's appropriate. Thank you very much for the introduction. So who here invests in gold equities? Nice. US listed gold equities? Okay, great. So majority are Aussie. And who invests in ETFs that are listed in Australia in gold? Cool. US listed ETFs tracking the gold price? Nice. So further to what Jordan has touched on, I believe this time, I hate to say it, and for those of you who've been in the industry for a while will know we actually can't say this time is different. So I was told not to say that. Compliance told me to take it out. But there are 5 factors supporting gold, and these 5 factors are going to continue to push gold to new record all-time highs over time. And the first catalyst is, of course, the Federal Reserve. So this part of, sorry, do you mind if I go back? Sorry. This part of the cycle, we've never seen the Federal Reserve be so clear as he was just recently at Jackson Hole. And this has really mapped out a big game changer moment for gold. And we'll get to that in a minute. But by far, every day we log in. Who's got a Bloomberg terminal? Anyone? Okay. When I log into Bloomberg throughout the day, I also get pinged to the annoyance of my colleagues on the desk. I get pinged every time there's a movement in the gold price. And I also get pinged every time that we see fund managers, investment banks, and the ETF industry at large increase their positioning in gold. And by far, this is one of the second major catalysts that we are seeing. That's actually number 5, getting my numbers mixed up here. But the number 2 catalyst is also that ping that I get every day on Bloomberg. Central banks are buying gold. I don't know, you can't really change the Bloomberg voice. It's American. Anyway, so geopolitical tension really picked up on the weekend. And of course, that is the third reason that we're seeing gold supported to higher highs. But one of the most concerning is we'll touch on, and it's not just a concern by myself and other strategists in the industry, but it is the concern, sorry, I think these slides have got a mind of their own. We're seeing concerns about debt to GDP. So debt to GDP is well and truly over $300 trillion. So debt to GDP, think about that, it's 3.3 times GDP. So it's a huge concern. IMF is wildly concerned about it. We'll touch on that in a sec. But this next catalyst, this next drive up, which we haven't yet seen yet, and that'll be ETF and money managers really starting to pick up their buying of gold. So for the first time since 2022, we've actually seen a big step ball change, and ETFs and investment managers have been buying gold. So if we go to that catalyst of every time the Federal Reserve has cut interest rates, gold has rallied to new record all-time highs. And I've been quoted in the media, they love calling me up because I'm quite bullish on gold, but I'm bullish on gold for very good reason. I'm facts-based and I'm scenario-based, and I look at probabilities and, of course, history. Who doesn't love history? So history, of course, never repeats itself, but it does rhyme. So if we do see history repeat itself or rhyme, there is a high probability that the gold price will rally up 99%. 99% to a brand new record all-time high. Of course, I'm averaging the last 3 cuts. If we go conservative and gold only jumps as much as it did in the pandemic, then gold will probably very soon see 3,500. So I've been quoted in the media saying that I see gold at $4,000. $4,000, that's right. So it's not far-fetched, and just wanted to reiterate, you can get my slides from Kerry, I believe. So we do know that gold actually has been outperforming the Aussie share market indeed. Of course, it doesn't outperform the S&P 500, but it's got a pretty strong correlation with it. Investment managers, and hands up if you work in financial advising. Cool. Nice. So I used to work in financial advising. So I don't know if you've seen, but there's increasing, I guess, pressure maybe being put on people who set asset allocations, i.e. Morningstar, to increase the amount that we should theoretically hold in gold. And no doubt that's going back to one of those key points. Debt to GDP is a concerning level. Second of all, geopolitical tension is rising. And of course, last but not least, Fed rate cuts. But what I also do like about having gold in my portfolio at all times is that it cushions the blow. And so, apologies, these clickers fast track themselves. It cushions the blow. So who remembers what happened in March last year? Can anyone shout it out? SVB, ring a bell? So we... Say that again, sir? Yeah, nice. So we saw the collapse of three small to medium-sized banks. Let's call them small. And then we saw, of course, one of the big banks have a little bit of concern as well. And then we saw central banks step in and essentially bail them out. Is there any chance that we can stop the slides from clicking forward? Okay, great. Let's work with it. So in March last year, the S&P 500 fell 6% in a very quick succession. It was 6 days, and in that 6-day duration, guess what? I've got it there, tip for young players, gold rose 6%. So this really does demonstrate why the investment world, why investment managers, Morningstar, etc., you name it, why we advocate for gold having a place in portfolios. The other thing that I do really love about gold is its correlation. It's negatively correlated, and that means when the S&P takes a tumble, when the VIX rises. Who remembers 3 weeks ago, the VIX was big, bad and ugly. We saw its biggest one-day jump in the history of VIX. I'm talking intraday, I'm not talking from high to low. So the volatility index is the market's fear gauge. And we've never seen a one-day spike in the VIX in history like we saw 3 weeks ago. And this is because there was a big concern about the amount of money that central banks, organizations in the US, etc., how much money they had been borrowing at 0% interest from Japan for 17 years. 17 years they've been borrowing almost 0%, right? And they've been using that money and they've been funneling into equities. And so there was a huge concern about, oh my God, wow, markets are crashing. Some of my friends who've been in the industry longer than me were like, yeah, this is it. The property market's going to crash, Jess. You're going to have your time. You're going to have your time to buy another property. It's going to be so good for you. Markets are going to pull back. This is it. That wasn't it. But markets fell 6%. But in that duration when markets quickly fell 6%, I'm talking about the S&P 500, the ASX 200 took longer to recover, but we did see gold hit higher highs, and that was pleasing to see. So that's another reason why we do hold gold in our portfolios. I don't know if anyone gets some Google alerts, but if you're trading and investing, it might be a really nice addition to add to your Google alerts to get pings of things you like. So in times of distress, replaying what happened in March last year when we thought there was going to be a credit collapse, and then 3 weeks ago that we thought there was going to be a credit crunch. In times of credit crises, and concerns of credit unfolding, i.e. maybe economies buckling, large organisations buckling, of course we see gold rally up. And the IMF has said it in black and white. So if you want to add to your Google alerts financial stability or crises, and every time you get pinged on that, I guarantee you'll see a higher high in gold over the coming week. The concern is this: so the financial burden is woeful on the global economy, and this is also why, of course, central banks, including the PBOC, China's central bank, is continuing to buy gold month on month on month upon month. What is also a concern is that the IMF has said that global growth is slowing. So yeah, we see US GDP, the economy rising, stronger than expected, but we're still cooling well and truly. And this is why gold will remain a safe haven play, and it's going to get a whole lot brighter. So here's the top 3 gold companies by market cap. So Newmont, of course, everyone knows Newmont. We swallowed up, I say we because I'm a shareholder, we swallowed up and took over Newcrest Mining, so Australia's biggest gold mine. Who's been inside a gold mine? Love it. Yeah, highly advocated if you can get out there. But you really do see execution of management at best, and cost control. Apologies about these slides. So Newmont, AEM, which is dual listed in Canada and the New York Stock Exchange. And then, of course, we've got Barrick. So these are the 3rd biggest by market cap. You'll probably see, I don't know if your eyes are as bad as mine, but I can just make out the market cap of Newmont. So Newmont, being the world's biggest gold company, as we're saying, it's got a market cap of $60 billion. That actually means it's just as big as one of our largest banks, ANZ. But I wish I could, I can't actually see the, there you go. I've put the ETFs that track gold here, which you can see they're not generating as much alpha or return as the ETFs that actually are buying gold companies, and they're digging it up and they're selling it as offtake. And we've seen some exceptional results from these 3 companies. And you'll hear market analysts, market strategists such as myself. We guide clients, and we also guide media into what stocks we think are going to outperform, where we think you should put your money so you can get bang for your buck. And the reason that I've been calling out that gold players are undervalued is not only because of those 5 factors supporting gold, but it's because earnings growth drives share price growth. We've seen exceptional earnings growth from these gold companies. And we've seen more earnings growth from these companies than we have in Australia's biggest banks combined. That's not hard because Australia's biggest banks are seeing declining earnings. So again, earnings growth drives share price growth. I strongly recommend that you do check out Newmont. The reason I've put it up there, what is EE? It's not a prescription medication. It's not Ozempic. It's earnings estimates. And this is based on Bloomberg earnings estimates. So when we talk about valuing a company, we're looking at future cash flow. Newmont, even though it's the biggest, I like big companies because they've got scale, and they've got skin in the game, and they also have the ability to keep their costs lower. And of course, that was one of the reasons that they took over Newmont. That acquisition was quite lucrative for them. And then we've got in the middle, the dual listed company, their shares, as you can see, AEM, they're up 50% this year, and Newmont is up 28%. So those 2 companies have well and truly that year-to-date performance. They've outperformed every single stock market across the globe except the US. So pretty exceptional, but myself and the investment world alike. You could say do believe, if you look at consensus, what the average is, we do believe there's more upside, and the time has not yet come for these companies, and there's more upside ahead. What's really interesting is, I don't know who holds gold ETFs, I can't remember, but if you look at the difference between returns that we've seen from gold companies versus ETFs that are buying physical gold bullion and storing it in their vaults around the world, we've seen better returns than from the gold miners. I haven't put up the returns from the juniors, but the juniors are worth a look as well, because of course we know junior gold mining companies, their returns have been dominating the leaderboard this year, and they've been doing exceptionally well. When I say juniors, I'm talking about companies that aren't as large in scale as these guys. Can anyone name a junior gold producer that's in the leaderboard up, say, 22% this year? Anyone? What's that? Spartan. Nice. West African Resources, Gold Road Resources. I'm only calling them junior because they don't have as much skin in the game as Newmont, for example. They're definitely not classified as juniors if you look at the ETFs. So we spoke about the scale and the size of Newmont. So Newmont being the gold giant, the world's biggest gold giant. You can buy it on the ASX and hold it next to your banking shares, and you can also buy it in the US. But on the ASX, if you have a look at the pair, compare the pair. So these two companies, ANZ and Newmont, they're exactly the same in market cap. They're now $60 billion. But I believe, and I think, this is my theory, I think that we'll see, just a matter of time, that Newmont will indeed become the 7th biggest company, and it could continue to climb the ladder and maybe be a top 5 company in the ASX. Who cares? I'll tell you who cares. So if you don't hold an SMSF, if you don't have a self-managed super fund, if you've got an industry super fund, the chances are that you're going to be compulsorily buying these companies each and every quarter with your superannuation guarantee. So I care, because that supports share price growth. Because think about ANZ. So ANZ may be the most unloved out of the big 4 banks, but think about this. CBA is actually the most unloved. If you look at dollars and cents, CBA does not have one single buy rating of all the investment banks and all the analysts who cover CBA. Not one single analyst out there has a buy rating on Commonwealth Bank of Australia. And that goes back to what I've highlighted here. Earnings growth drives share price growth. So the banks are declining, and their net interest margin has been declining for 10 years, whereas we haven't yet cracked blue sky yet for gold players. And I guess this also translates into their shares. So, I mean, Newmont shares are up almost 30% this year. If you also are trading Newmont, does anyone trade gold stocks, not just invest in them? Trade to maximize gains. So I buy pullbacks. And so when I buy pullbacks, when stocks like Newmont pulls back, guess what? I'm actually up by 67% just by buying the dip into gold. So gold also pulls back. But of course, like all quality markets and quality benchmarks, they always rise and have recovered over time. So I would strongly encourage you to, if you wanted to maximize your gains, look at pullbacks as your friend and buy into the dip. If the investment managers are doing it, why aren't you? So going back to compare the pair. So this is our trading app. I work for MooMoo, and we're Hong Kong and China, and so rather Hong Kong, Singapore and Malaysia's biggest broker. And this is just an example of what you could see if you logged in today. And you could have a look at ANZ's earnings report card on the left, and then also have a look at Newmont's. And you'd notice the key difference, so a beat and a miss. So when we are in earning season, a company's share price is driven by if it reports better than expected earnings. So tomorrow I'll be waking up bright and early, and I'll be going on Fox News in the US, and I'll be probably speaking about Nvidia if they report better than expected earnings. Better than expected earnings, people love good surprises, that drives up their shares. And this is the long-term trend for gold companies like Newmont, and that's why I'd strongly advocate that you have a look at Newmont. If you have a look, still compare the pair down the bottom. We spoke about benign earnings growth coming from big banks, so 2% earnings growth. You may as well not get out of bed because your money's not being, not even keeping up with inflation. But think about Newmont's earnings growth. That's estimated to be 52%. So remember, earnings growth drives share price growth. If I see you here next year, we'll be having a lovely conversation probably about maybe what you've bought with your profits from Newmont. Questions? Cough. Okay. Hopefully, yes.